Alright, let's just dive right into this explainer. You know, when it comes to cryptocurrency, the polarization is just extreme. Chances are you've seen the internet gurus promising you're going to make overnight millions, and you've probably also heard the fierce critics calling the whole thing a massive illusion. So what's the actual reality here? Are we looking at the future of money? Or is this whole thing just a giant scam? To figure that out, we really need to strip away all that internet hype. Today, we're going to look strictly at the facts. We're going to break down the foundational technology, the brutal realities of the market, and where the space is actually heading. Here's our roadmap for today's explainer. 1. Money without the middleman. 2. How blockchain actually works. 3. Understanding volatility in altcoins. 4. The crypto profit pyramid. 5. Wallet security and scams. And 6. The institutional future. Okay, starting off with part 1. Money without the middleman. Removing the bank. So back in 2009, Satoshi Nakamoto noticed a huge flaw in traditional money. Think about it. When you send money through a bank, you're not actually sending it directly to your friend. You're relying on a middleman. And that middleman has to check, authorize, and record the whole thing. Plus, they literally have the power to block your transaction if they want to. Bitcoin was designed specifically to cut that bank middleman completely out of the picture. It's a peer-to-peer system protected by pure math and computer science. It basically lets you send money directly to anyone, kind of like just firing off a text message. Moving right along to part 2. How blockchain actually works. Now, you might be wondering, how on earth do you verify transactions if there's no referee? Well, let's forget the intimidating computer science jargon for a second. Honestly, just think of a blockchain like a massive shared Google document. Everyone on the network has the exact same copy of this document, and they can see every single transaction happening in real time. If someone tries to cheat and alter their personal copy, well, it instantly doesn't match the rest of the group. Boom, they're caught and immediately kicked out. That's exactly why tampering with it is practically impossible. This whole system runs on a process you've probably heard of. Mining. Here's how it works. A transaction happens, and it gets broadcast out to thousands of computers all over the world. These computers then basically race against each other to solve these insanely complex math puzzles to verify the data. The very first one to solve the puzzle gets to add that new block of information to the chain. And for burning all that massive energy and computing power, they get rewarded with cryptocurrency. Alright, part 3, Understanding volatility in altcoins. Okay, we really need to contrast crypto with traditional stocks to wrap our heads around the market realities. When you buy a stock, right, you own a piece of an actual company with real employees and real revenue. But crypto, it's a digital asset driven purely 100% by supply and demand. Just look at this crazy timeline. In 2016, Bitcoin was sitting around $500. By November 2021, it had skyrocketed to $69,000. That is an unbelievable 13,700% gain. But purely speculative markets are absolutely brutal. Literally 12 months later, it crashed all the way back down to $16,000, which is a massive 77% wipeout. To put that into perspective for you, the traditional stock market swings maybe 15% a year on average. Bitcoin swings 4 times as much. And yet despite all that chaos, the sheer scale of this market is just huge. By 2025, the total crypto market cap hit $4.35 trillion. Trillion with a T, Bitcoin absolutely dominates here, eating up 58% of that value. People mostly view it as digital gold now, mainly because it has this hard-coded, totally unchangeable limit of exactly 21 million coins that will ever exist. Meanwhile, Ethereum and literally thousands of other projects are left fighting over the remaining 42%. But once you step outside of Bitcoin, the landscape gets wild and way riskier. You've got altcoins like Solana, built for super fast transactions. Then you have stablecoins, like Tether, which are theoretically backed one-to-one by real US dollars to stop the crazy price swings. But honestly, be super careful here because we also have algorithmic stablecoins, like Terra and Luna. Those weren't backed by real assets and they collapsed spectacularly, vaporizing $40 billion overnight. And finally, you've got meme coins, like Dogecoin or Peppercoin. These literally started as internet jokes. They get completely driven by viral social media hype, and then, predictably, they crash. Which brings us to part 4, the crypto profit pyramid. Who actually wins? It is definitely time for reality check. Let's strip away the illusion of easy wealth in this massively speculative, unregulated space and see who's actually making the money. Right at the top. The big exchanges, like Binance and Coinbase, they are raking in $15 to $20 billion a year just in fees. They win whether the market goes up or down. Just below them, the founders and venture capitalists. They got in at basically zero cost. In the middle, you have these massive industrial-scale mining farms, generating $10 to $11 billion annually. Or down, influencers make their cut by, selling you expensive courses. And then, at the very bottom, is the everyday retail investor. The brutal truth. Studies show 90% of retail investors end up losing their money. But even knowing all those documented risks, the adoption numbers are mind-blowing. Right now, a staggering 659 million people globally own some form of cryptocurrency. Think about that. That is a massive chunk of the global population deciding to jump into this decentralized experiment. But here's the reality check. In stark contrast to those 659 million owners, only about 15,000 stores worldwide actually accept crypto as payment. It's a glaring gap, right? It really highlights the massive divide between holding this asset for financial speculation and actually using it in the real world. Part 5. Wallets, Security, and Scams. Let's let this number sink in for a second. $800 million. That is the current value of 8,000 Bitcoin that were lost forever back in 2013. Why? Because a guy accidentally threw away his old computer hard drive. There's no customer service hotline in crypto. If you send funds to the wrong address or lose your password, they are gone. There is absolutely no undo button. And that is exactly why you have to guard your private keys, your secret passwords like literal buried treasure. You basically have two choices for storage. First, you have hot wallets. These are online apps. They're super convenient if you want to make quick trades with small amounts. But because they're always connected to the internet, they are highly exposed to hackers. Your other option is a cold wallet. This is a physical piece of hardware, like a USB drive that stays completely offline. It gives you fortress-like maximum security. But again, if you physically lose that little device, your funds are gone for good. And finally, Part 6, the institutional future, where the money is going. So despite the terrifying volatility, the scams, and the total lack of consumer protection, there is this undeniable shift happening toward mainstream institutional adoption. For years, massive Wall Street investors wanted in on Bitcoin, but couldn't easily access it. Then, January 2024 hits. BlackRock, literally the world's largest institutional investor, launches a Bitcoin ETF. And it absolutely shattered historical records. Starting from zero on day one, it sucked in an unbelievable $70 billion in assets in just 341 days, the fastest growing ETF in history. That right there. That signals a permanent, tectonic shift in traditional finance. And honestly, the momentum isn't slowing down anytime soon. Analysts are projecting the global crypto market is going to double, going from $5.7 billion in 2024 to $11.7 billion by 2030. It's wild to think about. What started as this underground, decentralized rebellion against banks has completely evolved. Today, major financial institutions are actively integrating this exact blockchain technology into their own systems as a foundational layer for the future. Love it or hate it, it proves this asset class is definitely here to stay. So, as the lines between traditional, highly regulated banking and the Wild West of decentralized finance keep learning, I'll leave you with the most important question. Knowing all the ruthless market dynamics, the profound tech shifts, and the immense risks involved, is your portfolio ready? Are you prepared to navigate the risks and rewards of this financial frontier? Thank you so much for joining me on this explainer. Keep learning,